Oh, hi, Melody. I'm just bubbling as you come online to say, thank you so much for talking to me. You're the author of M3 Substack. That's not how I found you. A colleague of mine sent me an interview that you'd done in recent times. Callum Newman, I'll give him a shout out, and said, "Oh, you have to watch this. It's such a brilliant rundown of the US market." And then for the next hour, I kind of sat transfixed listening to this YouTube interview where you sort of went through in with hardly taking a breath of what was happening in the US and just like rolling it off. And I thought that this is like a lady that's on my vibe because it's very rare that you get someone that has that much granular knowledge, of what's going on in the US. And I think it's not just that, but having watched a little bit of your interviews and sort of read some of your Substack and sort of been on top of that, I think it's the passion that you have, which is probably what I relate to so much about it.
Right,
I spend my
right.
life, sort of
Yeah,
analyzing real estate markets as well, and it's kind of quite a crazy passion to have. Nobody
hmm
relates to you in the outside world, but if you meet anyone in economics, you can sort of vibe with what they're talking about. So, I'm
absolutely.
really grateful that you've joined me today. And I rather than kind of start off, I've seen a lot of interviews where they're sort of like, oh, let's start off and giving a sort of overview of what's happening in the US. I kind of want to give my audience a chance to sort of get to know you a little bit better. And I'm
Okay.
super curious as to like, how have you ended up where you are right now? Um, you don't look like you're the average corporate, suited person that sits in an office. It looks like there's a lot more to you than that.
Yes. Yeah. No, sure. And thank you. And it's my pleasure to be here. And I'm excited because, like you say, I get very passionate, which freaks a lot of people out. But, I just am passionate about it. So I fell into mortgage in 2006 by accident because no one ever goes into it on purpose. Kind of you and I were talking before the show. I had a humanities degree. I was, I studying economics and as well as literature and things like that. But I took out student loans. And so I knew that I would not be able to be a professor and pay those student loans off because, in the US, they pay to become a professor is quite the ordeal, and it's really more of a political game. So I had been an executive assistant at the Wall Street Journal and a big investment banking firm. And so, even though I was in the humanities, I always had sort of one foot in the business world, mainly just out of necessity because I had to, make a living wage. And so, I just decided I moved to Minnesota, where I had lived previously for a little while during grad school. Got a job as a project analyst because I wanted to transition from that assistant role into project management. It just happened to be in a corporate financial planning and analysis group at one of the biggest subprime lenders in the country. And when I interviewed, the guy said, "So, what made you want to apply to a mortgage company?" I said, "This is a mortgage company." I mean, I had no idea. I really had no idea. And so that was in September 2006, right before the wheels started coming off the bus. And essentially, we were early to a lot of the trouble because we were in the middle of a transaction where a private equity group had purchased my company, and they could kind of see the writing on the wall, so they wanted a purchase price adjustment. And so we actually led the industry in write downs and things like that because we started to realize, homes stopped appreciating, as well as all this delinquency was starting to occur and things like that. And I just got a master class, one you would never get unless you were in a crisis. And I kind of became their girl Friday. It was a massive company, our company, GMAC. It was known by many names, ResCap, RFC. Today, you will know it by Ally Bank. That was how GMAC became Ally Bank. And they're in a little bit of trouble right now with subprime auto, which is very ironic. We can talk about later. But basically, I went across this company gathering all the management reports, and I had to teach Cerberus, which was the private equity firm that purchased us, what the business was. And so I learned that all. Then through the crisis, we had several rounds of layoffs. So I became kind of like one of the last people standing. I was young, so I was cheap, and you know how that goes. And
Yes.
so like in 2009, I spent 185 days in the office straight. And this was, I mean, Saturdays, Sundays. I mean, we were just going through, what are we going to do? Are we going to file bankruptcy? And so it was absolutely nuts. But I learned so much about kind of non-banks and what happens because they don't have deposits when they are lending out in the mortgage market. They rely on big, liquidity facilities or borrowings. So fast forward, we make it all the way to 2012, and then we had almost filed bankruptcy in 2009. We made it all the way to 2012 because in 2010, you may remember, there was a tiny refinance boom that kind of kept us going. But then we got into, this is what's crazy, Catherine, and I think this is important, is that we quickly turned around. By the time 2007, 8 came along, we weren't doing subprime lending anymore. We had always had a big agency or government book. But we really went all in on the FHA product, which, for your audience, this is kind of it's supposed to be for first-time home buyers. It's supposed to be a way to get first-time home buyers who maybe don't have a large down payment into a home. And it's the big program here in the United States. But we got into that, and we were trying to do the right thing. And ultimately, I think doing the right thing is why we had to file bankruptcy, because you just really couldn't afford it. And so I actually helped with that. I was in the courtroom for day one. Motions for bankruptcy. It was one of the largest bankruptcies and the most complicated of its kind at that time. We kept originating while in bankruptcy because people wanted our assets. Buffett, others, there were a lot of people there that wanted to take this stuff because a lot of it was really good. Okay, done with the bankruptcy. My president says, you need to go manage default. This department's in a lot of trouble. We need your help. We need you to turn this around. So I did that and spent a year on the road going out all over the country, trying to get defaults resolved. And that is where you say, I taught very granularly because I learned back then, as much as we want to look at things in the aggregate, we cannot. If we really want to solve problems, we have to go to the local level. And so that's what I did. I went out on the road to resolve these things. And I did. Fast forward, my company was purchased by a company I was not at all wanted to work for because they did a lot of offshoring. They were known to be the worst actor in the industry. It was crazy. So I went off to non-bank firms where I tried to help them understand the new regulations. What I quickly learned is that no one wanted to really do the right thing. So that was a very frustrating few years. And then I landed in fintech because one of the biggest issues in the United States is that these mortgage companies, the technology dates back to the late 60s, early 70s. And so I started building technology. I had that background as well. I'm one of those people, I like to learn something and then I move on. But I've been stuck in housing for some time now. So at one of those fintechs, because I had that economics background, one of my presidents said, hey, we need you to tell us when rates are actually going to rise, because that would change the entire game, right? And so I started diving into macro again, something I had done in graduate school. And one day I woke up reading a Bloomberg article. It was saying that the housing market was about to turn around, and I was just so angry. I decided to get in my car and drive thousands of miles across the United States and visit some of these boomtown markets. And so I started to gather. That was probably my first viral tweet, was when I went to Austin and saw that there was all these vacant homes and they were just building them everywhere. And that's how I got all the way here. So I know that was a very long answer, but it was all by accident that I got here.
What year was that? What year was that where you saw all those vacant homes being built?
2023, January of 2023. And and what was so crazy, so I started, Nashville was my first city, Austin, then I went to a whole bunch of Florida cities, Charlotte, and I thought, surely awareness is around the corner. Surely people will see this and understand we're in a bubble. Then very quickly We had the bank failures in the United States, which all felt very familiar, right? It was like, okay, it's all coming apart, very similar to the way that it did back then. But they were so ready, right? They had those facilities, they backstopped everybody. And then, we kind of had this AI sort of this, mania start. And it kind of, so the market just kind of turned around, and you can see this on every chart. You could see home prices coming down in the United States and kind of the end of 2022. And when you look at almost every city, that was the peak, was sometime in 2022. But things just started going again. It was as if people were told, free pass, keep doing what you're doing. We're going to backstop you. And, it was really, since then, the only thing that has kept, and really the market is on life support, but everybody has that hopium that rates are going to go down, not understanding how mortgage rates in the United States work at all. And it's been very funny. This is our second September where the Fed cut and mortgage rates stayed stubborn and even rose last year. So, but yeah, that was 2023 when I thought awareness was, just right around the corner. Nope. I forgot 2024 was going to be an election year. And so they did all kinds of programs to keep things afloat. In that FHA program, because you already saw in June of 2023 massive surge in delinquency. So they came out with one of the most generous loss mitigation programs I've ever seen. Generous is not even the word. It became heavily used fraudulently because it was so generous, and it really kept things going for another year. But all of that is October 1, the brakes have been put on that and the guardrails. So, I think that it just got delayed, that awareness that I thought should happen in 2023.
There's so much to talk about there. First of all, let's talk about because when I'm writing, and I have a few American subscribers, and I have one that wrote to me after I think I put out a report, would have been a few weeks ago, saying America's peaked. We've reached the peak of this cycle. You've kind of got to sit where you are right now, because it's only going to be a matter of time before we hit that point, as we saw in 2008, where everything's going to collapse, and then we're going to be in the same situation again. And I know you've talked a lot about that in the interviews that you've done, but the response that I had from one of my subscribers was, well, hang on a second, you're not right, Catherine, because they're going to slash interest rates, and that means that people are going to go rushing back into the property market. It's never really been my forecast for a slash in rates. That normally happens when you have a crisis, sort of not.
Correct.
But I'm
Right.
curious as to, I don't think people do understand here, the way the cash rate works here isn't quite how it works over there. So can you explain that for us?
Absolutely. So, the Fed has short-term interest rates, and but they can't control the long end of the curve. That's the bond market. Try as they might, and I believe that they have been trying. And so, essentially, mortgage rates in the U.S. track the 10-year Treasury because typically a mortgage in the U.S. pays off or refinances every 7 years. And so that 10-year really, in my opinion, is the world's borrowing rate. And so what we've had is we've had a lot of international buying kind of step back. Now, people will say they've been kind of piling back in recently, and that is true, but that step back makes a difference. And so when rates have just stayed sticky, no matter what they've tried to do, and there's all kinds of theories on why this is happening. There's theories that there's in a short, sellers that are in the bond market, things like that maybe are impacting. But what's, I kind of feel like in times like these, it's never one thing, right? It's multiple things. But what you can feel is this resistance at kind of this 4 mile marker. You can't, no matter, we dipped slightly. So when the Fed cut rates, the bond market kind of responded. It went below 4 for like 2 minutes, and then went right back up to where it was. And this is even after, Bessent, Treasury Secretary Bessent, has said he wants to get the long end of the curve down. And so the market dictates mortgage rates. And also it's kind of complicated recently we've seen the spread between the 10-year treasury and mortgage rates. It was the widest we've ever seen. And this is important, Catherine. Why we got such low mortgage rates during the COVID boom is because the Fed started buying mortgage-backed securities. And so they were just gobbling these things up to the tune of $2 trillion. And that really helped tighten that spread because there was so much appetite between the 10-year and mortgage rates, 30-year mortgage rates. But it was only efficacious for a short amount of time, actually. They bought another, when we got our lowest rates, they bought another 700 billion after that, but it didn't make a difference. Rates started floating back up. And so we have seen a little bit tightening of that spread. And I wrote about this a couple of weeks ago because actually we've seen increases in foreign mortgage-backed security buying. But what so many people don't understand in financial media and everywhere else is like it would take something like that to actually get mortgage rates down to a point that would be effective in the market. And I mean, and they would have to go very low. The problem, though, is of course, the Fed also bought mortgage backed securities in 2009, and it did not save the market. And so I believe where we are right now, even if you had, increased buying of MBS, we would not get to rates low enough that would truly turn the mortgage market around. And right now people are talking about the two big government agencies in the United States, Fannie Mae, for government sponsored entities, I should say, going private and being allowed again to buy MBS. Well, I think they would just suicide themselves like that. That's not going to save the market either. And so it's way more complicated than the Fed just slashing rates. And as you rightly say, when they do that, we're already in trouble. And so we're at such peak unaffordability right now that even if what you're seeing is people applying for refinances and getting rejected because credit quality has degraded, because credit scores were inflated, because student loans were not reporting to the credit agencies, because there were no evictions, because there was a mortgage moratorium. And so everybody looked a lot healthier than they actually were. Plus, buy now, pay later was not reporting to credit. And so you had all this private credit out there that wasn't actually getting reported. And so the consumer balance sheet is much worse than what it looks like when the Fed does its household debt and credit schedules, because they use one reporting agency called Experian here, and that's not capturing everything. And so with those, now people have seen their credit scores drop 100, 150 points as those delinquent student loans are reported again. And so, and also they're more debt burdened. And so they're not even able to qualify for those refinances that everybody is hoping would turn the market around.
Mm. I kind of want to ask you how this differs from what was happening in the lead up to 2008, which I'll come to in a second. But you said a few things which were really interesting. One about how you felt that the peak of the market really was 2022. I
Yes.
think we'd almost say the same in Australia, because we had such a huge stimulus that was pumped into the economy. People found they had $10,000 in their bank account if they were a business for job
Yes.
save programs and whatever else, which of course wasn't used to save anybody's job. People went off
Mm-mm.
afterwards, but it flowed into the land market, and then we saw property prices explode, particularly because we still had low rates at that time. And then through 2023 we had this rapid rise in lending
Mm-hmm.
rates, which was the fastest and steepest on record.
Violet. Yeah.
Yeah, which kind of stalled everything. And then we've
Yes.
kind of seen it patchily, we're sort of at a new peak now, but it's not really built on a solid foundation. It's not built on
Right.
the fact that fundamentals in the economy are really
That's
strong.
right.
And as you say, in America, these fragments are breaking underneath and you're seeing it, but it's being covered up when it comes out in the
Yes.
statistics and the mainstream financial press. It's looking a lot better than it was. So I am there's so much to unpack about where we are now, but I am interested. I've heard a few comments of yours about what happened in the US after 2008. And you seem to insinuate, I think, in one comment that I heard you make, that you didn't feel that there'd been enough of a washout, that it was
Oh
kind of,
yeah.
it should have washed out a lot more than it did. And really in Australia, we were bailed out as well. So, I mean, we didn't
Mhm.
have as much of a washout as we should have done. But looking,
Right.
it was much better than what we saw in the US.
Yeah, and it was absolutely, so Wall Street came in and bought up all those homes, and they did it at the behest of those government sponsored entities. I was there. I went to those auctions. I saw it happen. And so you had these large asset management, Blackstone, others come in and buy up all these homes that were in foreclosure. And so what they did is they turned around and then did long-term rental for those, because people couldn't were getting kicked out of homes, so they needed a place to go, and rents, were decent, so that it made sense based on how low rates were for these private equity companies to buy up these homes and kind of bail out the GSCs, those Fannie and Freddie Mac. And so we never got the full washout completely. And I mean, honestly, too, you had the state AGs or attorney generals step in and delay things so much that right now, Catherine, I'm helping two people in the Northeast with foreclosures that started in 2007. Okay. So they've been in foreclosure since the crisis. So I think, and now we're getting to a point where those institutional investors have to be net sellers because, and I actually met with one of them 2 weeks ago in Dallas, because they can no longer get funds cheap enough to cash flow, especially because of property tax and insurance increases. And so I believe what's going to happen, because the US market is about nothing but investment at this point. It's all about second homes or buying to do short-term rental like Airbnb or Vacasa, or buying for long-term rental. Because what happened when Wall Street came and did this, then we got all these shows on television about fixing and flipping homes, taking those, what had been vacant homes during the crisis, and fixing them up. And you couldn't even watch television without seeing one of these shows. And so everybody kind of got the bug. And then when COVID hit, when we had that revenge travel and whole families would go on vacation together, they never do that, right? Like, I mean, extended families, everybody's like, oh, I'm going to buy Airbnb or a home to Airbnb and do short-term rental. And Airbnb was really smart. Anytime you search their website in, let's say, San Diego, you will only ever get 1,000 results, period. It does not matter that. And so most of their hosts didn't realize actually there's 12,000 Airbnbs in San Diego. And so all these people piled into the game. And now what you're having is travel is down, but also you don't need 12,000 mini hotels in San Diego. You don't need 15,000 in Austin. And so these things are coming onto the market as these guys aren't cash flowing anymore. So yeah, it really, at the end, that bailout started back then, and we never fully got to see. I mean, all of us in the industry really did not believe it was over, and it was just very sudden, because of them really taking up all of those homes.
Talk to me about, because I'm going to come to Airbnb in a moment, because then we'll go through the idea of the vacancies and how vacancies are hidden. I think you'll be interested in some of the research we have in Australia, but the foreclosure process. Talk to me about that process, because this isn't a simple process. People kind of imagine, oh yeah, you foreclose on your home, you give it to the bank, gradually kind of filters it off onto the market. Eventually it gets wiped out, they get sold, and off we go again. It's not quite that simple, is it?
Oh
How
no.
can someone still be in foreclosure from 2007? What is going
How
on?
indeed, right? I mean, so it became it's so crazy because all of the real warts happened at the time of origination, of those loans, but for some reason servicing is just simply taking your payments, that kind of thing. That's who got in trouble, because they were saying that we were wrongly the industry was wrongly foreclosing on people. They did massive reviews and never found one of the big five that was wrongly foreclosing. But they use it as an opportunity. The AGs use it as an opportunity to kind of stop the foreclosures and stop the crisis. In fact, Tim Geithner said in Senate testimony, all of this was about foaming the runway for the banks to kind of slow down that process. And it doesn't work like when we watch It's a Wonderful Life every year at Christmas, where, like you say, the bank just comes take your no. I mean, each state has a Byzantine process of noticing, and in states like New York, they never finish. They just, I mean, there's just so many ways to stop the process. And in fact, I pretty much know a way to stop the process in all 50 states. There's a way to do it. And so it is very difficult. And despite what you might hear in mainstream media, no company wants to do a foreclosure. It's very costly. And that's why that everyone was so excited to let Wall Street come buy those homes up, because carrying those houses, I mean, when you in the US, because our market is all based on securitization, if the Big Short, it's important to understand that, because it's not like the bank just giving you a loan. It gets sold off that loan gets sold off into a secondary market and pulled up into securities. And as part of that, as the entity that's holding that servicing right, you have to pay property taxes and insurance when the borrower doesn't pay it. You have to pay the payment to the bond investors if the borrower doesn't pay it. So you're advancing out tons and tons of money with not getting it back. I mean, that's one thing I used to track every single day with something called servicer advances, because you're sending that money out, not getting it back. So you can imagine the kind of liquidity drain that happens, and it happens very quickly. And so that's why these entities don't want to hold on to those loans, because they cost a ton of money. And even though they're theoretically backed, like in the FHA case, you're supposed to be able to get 100% of your losses back. That never happens. It's like any other insurance company. Your claim gets curtailed for some reason, or they make you repurchase the loan, because what they'll do is they'll look and they'll say, okay, you didn't dot an I on that loan application, you have to buy that loan back. So they're very crafty in the way they do that. So, but foreclosure is a very lengthy process in most states, except for Texas and Georgia. But most other states are very slow, and it's political. So it just that people, they don't want it to. It's become really politicized in the United States, and so the politicians typically put a stop to it.
And the current first, because one of the things that is the feature of every cycle, of every crash, is in the lead up you have this tremendous amount of mortgage fraud, which is covered over. You don't actually see it. If I see it here because I work in the industry, so I can see the ways that people are able to borrow more money than the banks would, are supposed to allow them to do. But there's different ways that you get around it. And because I hear this all the time, not just from mortgage brokers, but from buyers that want to borrow more and they find some way around it. And then when we borrow it, whether we're manipulating, rental, what the house might rent for, and bumping the rental price up, or whatever else it is, it kind of all goes into the system, and then everybody thinks, oh, it's okay, I'll be able to afford it. I've lied about the income it was Bill Mitchell who wrote the best way to rob a bank is to own it, that kind of documented what happened in the savings and loans crisis, which was mortgage fraud. And then because we got to the subprime crisis, for again a massive amount of mortgage fraud, which just uncovered at the end. What's happening right now? I've heard you talk about that in terms of the incentives that are offered to first-time buyers in the US.
Yeah. So the Philly Fed put out a paper in January 2023 that said, hey guys, guess what? Mortgage fraud did not stop after 2008. In fact, it kind of accelerated, and that because this is such a market that investors speculate in, you can pretty much say that 30% of whatever investors are doing is fraud. That's what the Philly Fed said. Now, basically what they were doing with this FHA program, and they did it back then too, Again, this is supposed to be for first-time home buyers, but they really relaxed all that. But it's a way to get a mortgage with 3.5% down instead of your typical 20%. And you can have a credit score as low as 580. So essentially, it's government-backed subprime. And what's really important, so I'll get to that fraud part, but also people will say, well, FHA is a tiny portion of the market. No, it used to be. It's doubled since the crisis. It's now around 13%. Well, guess what percentage my book of business was in 2007 that was subprime? It was 12%. So we've just flipped. And so instead of the private market doing this subprime, government is now doing it. So what happens? So these investors are like, hey, I just lie and say this is going to be my primary residence. I'm going to occupy this. And they don't say that it's for investment. And so that's owner occupancy fraud. And they get these loans. And then I think what we're going to find is you can go look this up actually it's called Neighborhood Watch. It's the FHA website, is that there are specific entities that 50% of what they're originating has had early payment defaults. What is that? That's when you miss a payment in that first 6 months to a year. That is your biggest, you see that smoke, there's fire, right? Well, 50%, that's fraud. And so these agents are being coached about this. And then you tack on that loss mitigation program I told you about. These people were told they wouldn't have to pay mortgage ever, but before they sold it, if they were going to try to like buy it and then resell it or something like that, because this loss mitigation program, essentially you could say you could not pay your loan for 3 months. And this is after all the forbearance and everything else. And you go, hey, I couldn't pay it. They said, that's okay. We'll put it in a non-interest bearing lien at the back of the loan. And then maybe you didn't pay for 3 more months. You could come back. You could do it again. You could do that to the tune of 30% of the unpaid principal balance, which is a ton of money. And that's what was happening. And one of my colleagues, John Comiskey, basically did the research. And if you get one of these partial claims, it's 5 to 7 times more likely to go delinquent again. So this was being used fraudulently. And so there's a ton of it out there. And that's in that market. But in the private market, you also have it as well. And I just helped research a case in Arizona where there is $4.6 million in leverage on a $1.9 million property, because what this person did is they basically got one big loan from kind of an official lending institution, but they also got a whole bunch of little loans from private lenders, just Joe and Jane Doe, like giving money, and then they would file what's called a release on public record, having never paid that money back, as well as there was a hard money lender. So they use this house as a piggy bank to go off and get refinances. Now, during COVID, things weren't getting recorded at county record, which is how you know what's happening on a property. Because there were delays. Like Los Angeles had a year delay. So people could go get multiple mortgages and it wouldn't even be showing up on a title search. And so, this is what I think no one understands is that, and I think was true of that. It wasn't the subprime crisis. That was part of it, but there was a lot of fraud and that was more of it. And then the contagion effect from the fallout of, Lehman, Bear Stearns, things like that, people losing their jobs. That's when the true crisis was around the prime borrower. That's who, essentially that was the massive wave of foreclosures, not because subprime wasn't even really that much compared to the larger market. And so I think we're basically, believe it or not, playing out the same dynamics, except I think the fraud is even worse this time.
It's so interesting because what's happening here to push the market into that peak is exactly the same thing, which is a government-sponsored subprime mortgage boom. And what the government have done here is that they're handing out to first home buyers, you can buy with just a 5% deposit. and we'll take away any mortgage insurance that you need to have, which is normally, if you have buy on such a low deposit, you need to pay
Right.
lenders mortgage insurance. Not that that really would even bail the lenders out if the market went, but they've sort of taken away that, and there's no income cap on it. There's no matter
Right.
what your income, you can come into the market like this. And just as you say, there's the idea is that you're going to live in this property, but no one's really watching closely what happens once the property is settled. It would just be impossible to monitor that. So
Right.
we've got suddenly the market there's a fire that's been lit under the market, and we don't have a massive amount of stock on the market at the moment, and so all areas are like starting to take off. And so I'm fascinated that exactly the same time in the cycle, that's sort of what the US is doing as well. And I've written about this before, which is in my mind, I'm like, gosh, you're pushing all of this. The government is now, rather than the banks doing this subprime mortgage boom, the government has come in and done it. Normally, what you need the government for is to bail things out when everything goes wrong.
Right.
But now the government's
Right.
throwing everything in. What more is there to throw in once the market
Right.
was on the other side? So there's kind of like,
Right.
bad is this crash going to be if the government has no more ammunition to put into the
Right.
housing market? Because as you and I know, housing is the economy. Land is the
Right.
economy. We need it for
Right.
everything we do. Everything around
Right.
us is made from land. So if you start allowing that to be monopolized and these financial products to be built on top of what's going on with land, when that land loses its value, it not only brings down the economy, but it brings down all those businesses that have choreographed themselves around the land market for this so-called wealth effect. So
That's
everybody
right.
kind of crashes down at the end, and it's an extremely bad. But let's kind of build this picture even more, because you talked about 2023, you driving out, was it to Arizona? And
Yeah, I went to Phoenix. I went to Phoenix in 23 as well, Arizona, but I started in Nashville and Austin, Texas, and Florida, which is always the home of the bubbles. So,
well, it is, and I've written about Florida quite, because Florida really is like the bellwether state, isn't it, for
oh,
the
always.
and it was actually leading into the 1930s Great Depression.
Oh,
Florida
yes.
went
100%.
in 1926, 100 years later,
Yes.
here we are again,
I know. Here we
which is
are.
a great cycle to sort of be aware of. But yeah, who was it? Oh, I'm trying to remember their names who wrote the paper. Housing is they looked at building permits across
Hmm.
100 years, and they noticed that building permits are kind of like a forerunner of stock market downturns. When you see that peak and the building permits start to go down,
Right.
that you're sort of coming up to this. I'll link to that in the report that I send out with this. But yes, sorry, please go on about the vacancies that you saw.
Oh, yeah. Well, I just mentioned two books, Bubble in the Sun and Swamp Peddlers. And they, Bubble in the Sun talks that they believe that exactly that land grab and then the collapse is what really caused the Great Depression. And so, but it just shows you that this is cyclical, that this always happens. In fact, when I went to Florida that first time, and then I lived down in Miami for a couple of months and drove all over Florida. I went to subdivisions that had been razed, that had been bulldozed, and they built right on after the last crisis, even after the depression, and they were building there again. I mean, in the middle of the swamp. Like it's so crazy. And they were just building, and they're vacant. I mean, these aren't being, I mean, I have been to new build communities all over this country, some of them out in the middle of cow pastures, feedlots, like, I mean, no infrastructure, and they just built them in the middle of nowhere, and they're vacant. And we're seeing, and so in the US we have a myth about inventory. There's a whole bunch of reasons people think we have a shortage of units. We have a shortage of affordable housing. That is for sure, because people are deluded as to what they think that their home is worth. And that's on purpose to feed that wealth effect that you're just talking about. Because if they think that they have $300,000 in equity, they're going to go out and buy more. And that's desperately what they needed to happen to restart the economy. And they've used it like this for a long time. Anytime we get into trouble, let's try to juice housing, right? But yeah, the vacancies are everywhere. Not only that, the census tracks, we have 15 million vacant homes that are not used for seasonal use. That is insane. And that's the boomers, their first, second, third homes, that kind of thing. And so that on top of all the building that we've done, which is the most since the 70s for also multifamily, and that impacts the housing market as well, just means that there is a ton of vacant property. Right here where I live in East Tennessee, you can drive down the road and see um, a bunch of these vacant residences, because also what happens, people would buy them thinking they were going to fix and flip them, but then they ran out of money and they couldn't finish it. And what you're seeing, you may have seen Redfin came out yesterday or the day before saying that August they saw the highest cancellations of home sales that they've seen, like in August, ever. And that's a lot because what happened during the COVID boom as well, when people bought, they waived their appraisal, they waived the property inspection, bought it without any of that, and then they didn't make the repairs. And so a lot of these sales are falling through because the homes aren't in the shape that would support that Zestimate, which is Zillow's little appraisal of what the house is worth. And so it is just so shocking, actually, how much vacancy there is all over this country. But the new builds, many of them, they will be bulldozed again.
And what's interesting is the incentives that the developers are offering on those builds to get people to buy them. I heard you talk about that as well.
It's insane. I mean, it's actually, so I was just in Dallas, which I just feel for Dallas right now. I mean, it is going to be so bad there. But I was just in Dallas, and they're offering a buy down where they buy down your mortgage rate at 3.75%. They were offering $50,000 price reduction, as well as a $5,000 gift card to Pottery Barn and a free refrigerator. And so we can't look at what they report new home prices as. I mean, we basically have to reduce that by $50,000, which means that, in the new home market, homes are selling around that $350,000 mark, which is far below what the existing home median price is, in like around 420,000. And so this, people in the housing industry like to ignore the new home market, but it's more and more taking market share from the existing home market because it's pulling people into these, because it's all that people can afford. But yeah, the builders have gone, we call it the incentive wars, because, they're beholden to the street, Wall Street, and they've got to, they're like a factory. They're not like just a regular person selling a home. And so they have to make good on their promises. And so they just, there's this survey called the National Association of Home Builders Sentiment Survey, and it just came out and said that in September they had the highest percentage of price cuts ever in that series as well.
Which
So
is
yeah,
incredible. Yeah.
it is.
What's really interesting is how similar it is to what happens here, because we see the same incentives done on new builds, and developers wanting to get anybody to buy them, whether they're offering rental guarantees or we've been through that similar cycle. But what we did over here, and this is with an economics organization I'm associated with called Prosper Australia, and each year we do this survey of how many properties are vacant, and this is just in Melbourne, which is the second biggest city by population in Australia. And we look at water usage data to work out how many homes are vacant.
Oh, nice.
We take the water usage data for each suburb per home, work it kind of out who's using no liters of water and who's using just such a small amount. It would be like a leaky tap, or, they're hardly home sort of thing. You couldn't live there for that
Yes.
amount of water. And we're coming back with there's 100,000 homes, and this is over a 12-month period. There's like 100,000 properties, and I would imagine that the way that Melbourne is, I mean, most of those would be, or a large percentage of those would either be in the apartment market, where you're getting these towers that are not
Yes.
completely occupied, or in the new estates, which is just like you say, in
Right.
suburbia, where
Yes.
you get these cookie cutter houses that are built,
Yes.
one after the other by the developers, that they can't turn over, or if somebody has
Right.
bought it's not being occupied, or maybe it's a holiday home or whatever else. So
Right.
it's a very, very similar dynamic. I guess nobody has really done that type of study. I think there have been, when I was, because I've written this paper a few times, it's called the Speculative Vacancies Report. Again, I'll link to it in the show notes. But I think when I wrote one of the papers, there had been not a water study done in the US, but I think they'd done it by, postal code or something to see about whether people picked up their postal to try and work out which properties were vacant. But I'm assuming that really nothing like that. Who's counting the number of vacancies? Is anybody looking at that?
Theoretically, the census, right? But, I think they're understated. I mean, you just gave me an idea. Like, I'm going to
Yeah.
go see if we can, because it is way more. Because where I live down in Miami, I lived in what we call the ghost condos, because they're used for money laundering sometimes and things like that. But it's foreign buying, and nobody's in them. I mean, I lived in a massive condo with like 20 floors, and it was me and three other people, and I would look out across that area of Miami and at night, and there'd be no lights in these condos. And so, you know I am going to check out if that's something that we could do here, because I feel that we have no idea how much vacancy there is, and we also don't understand anything about like true patterns, migration patterns, because what happened here is everybody thought people were moving to these cities in the South. But in reality, it was a lot of it was temporary. It was hospitality workers who, because the South was more open during COVID, could get a job where they couldn't get one back at home. But it was also construction workers as well as immigration here. And so a lot of that population booms that everybody thought was happening in the South in reality are not. And so if we had ways to track that, there's a company called Placer AI. They track cell phones. And I would love to get their data, but it's very expensive. So, but I am going to check into the water thing because that's brilliant, actually. So,
Yeah, it took us a while. We used to walk the streets to see, which properties were vacant, and kind of try and deduct it that way. And then one of our volunteers came up with this idea, and this was years and years ago, because it's been going for well over 10 years that we've been doing this. But
wow.
he said, oh, why don't you look at water usage? Because everybody has to be with a certain water company. It's not like electricity
Right.
where you can kind of choose
Exactly.
who you're going to be with. And that was kind of how it started off. And it's a great report to get into the media, because the media love the headlines of a ghost city. You're just like, kind of
Yeah.
like, this suburb is like a ghost town because there's so many
Yes.
vacant properties that are in it.
Right.
And then that opens.
Right.
Actually, what happened here was that the ABS, government agency that collects all of our data, started to take note of it, and now they're trying to do their own reports,
Wow.
to sort of look at vacancies. We have things like a vacancy tax that came in on the back of it.
Yes.
So, various, sort of like little tweaks to housing policy that sort of ran off from that report, which was
That's
interesting.
awesome.
But what I find really fascinating as well is your commentary on Airbnb, because these stats are very hard to get hold of as well. We have various cities that put in Airbnb laws to try and sort of limit the amount of Airbnbs, but who's actually out there counting exactly how many Airbnbs you've got? Because if you're in command of if you're governing a city, your housing is the most important factor, and you want that housing to serve the population that are living there,
Right.
rather than the holidaymakers that come in and out. You need to be aware of that balance, and, like you say,
Right.
migration patterns, so that you know
Right.
exactly what is needed.
Right.
How did you collect the stats for that?
So, well, a few ways. And I think that is how, you have to do everything these days, is triangulate the data. But there is one nonprofit. He's a citizen journalist inside Airbnb. I believe he even tracks Melbourne. Yeah.
Yes, he does. I
Um,
remember now. Yeah, yeah,
yeah.
yeah.
It's Murray something. I can't remember his name. That was one way. But then I actually got access to AirDNA data, which it was so crazy. Like, wouldn't you want to offer this to your host, Airbnb? I mean, wouldn't you want them to have information so they can make good decisions about whether to buy or to get involved? No, they didn't. But AirDNA came around, and Airbnb kind of made a deal with them that they would share Airbnb data with this company AirDNA, and so you could get how many were in the cities, but what you couldn't really get was actual occupancy numbers. Because so I was working on part of what I was doing down in Miami was helping this small mortgage bank who wanted to create a true underwriting tool for short-term rental, because that was largely who they were lending to, and they felt AirDNA and others were not being realistic, because what I came to find out, because we had subscription to those services, is that they give you the optimal view of occupancy, which is not realistic or anything like that. But it was through a private company that, of course, you'd have to pay to truly get the information, which they weren't giving you the full story. And so oftentimes, like, for instance, they weren't doing good comps, put it that way. Like, for instance, they would say in Kyle, Texas, which is 20 miles south of Austin, that you could get an average daily rate of $600. There's no way. Like, maybe once a year, but that's what they were feeding people. And so people were lending using that tool and thinking that's what you would get. And so, but anyway, that's how I got a lot of that information. But you had to pay for it. So
But it's the occupancy, isn't it, of Airbnb? I mean, I
yes,
think there were so many spruikers that came up in that. Spruikers it's an Australian term for kind of like people that come and pump the market, or kind of spruik
yes,
the market. And they sort of came out after the when Airbnb took off because of the COVID situation, and everybody started to bombard the Airbnb market, and you got people jumping on that bandwagon for how you could use Airbnb and how you could rent a property and then use your rental property and put it out onto the Airbnb market. I saw all
right,
sorts of things kind of come up on your Instagram feed of the adverts when you
right,
scroll through, of how you sort of get rich quick. And what we saw in COVID was how that added to the vacancy,
yes,
rental vacancy rate when COVID hit. And obviously COVID was a very unique event where you couldn't go and stay in short term. It would be a different nature for this kind of downturn. But have you thought about that? Because I can imagine that along with those vacancies that you've already got on the market, we have a lot of underutilized housing, and that housing, as you and I know, it's when you have a financial downturn and people need to generate income that the housing floods the market. Well, I need to sell the property because I can't afford the mortgage, or I need to
yeah,
rent the property, so the vacancy rates go up.
yes.
I'm wondering what your thoughts on that are.
Oh, absolutely. And so I track 85 markets like each week. And I did a combination of the major markets plus all of these Airbnb hotspots. And what you can see in all the Airbnb hotspots is that is where inventory started to grow first. And I remember a few short months ago, people told me over and over nothing would happen to San Diego. You can look at what's happening to San Diego right now. Prices are coming down. And people said, no, you've got the Department of Defense there. You've got the military that subsidize that market. You're never going to have any issue in San Diego. But sure enough, because all these people bought these short term rentals, a lot of them use their veterans benefits to do it illegally. That's the market's being absolutely flooded as these Airbnb owners cannot make money anymore and they have to let go of these properties. And so you're definitely seeing it. I mean, places like Nashville, where entire sections of downtown are just short term rentals, for sale signs are going up everywhere. And so this is what people don't understand, is that it is, as you so rightly say, it was underutilized housing. And that now, as we're entering into this tourist downturn, it is going to flood the markets. And that's exactly what's happening. And they're everywhere. They're in places you would never expect them to be, because everybody just thought, I mean, I don't even know what they thought. They got some brochure in the mail. They never went and visited, and they just believed what the AirDNAs were telling them. And it's like, and that was all based on nothing, really. So it's going to
Mm.
have a huge impact.
So let's kind of get down to the nitty gritty of this, because how is this going to be compared to what we saw in the global financial crisis? I mean, what's interesting about you and me is that I've kind of come to this from a cyclical point of view, which is that I've had the date of the downturn forecast for a number of years, and I've done that based on a long-term housing cycle that actually Homer Hoyt talked about when he wrote his 100 Years of Land Values in Chicago. Roy Wenslick, I don't know whether you're familiar with the names, but a lot of studies were done in the 1930s that recognize this on average 18-year cycle, and that's how I
Right.
forecast when this downturn is going to come. And because everything is lining up with that now, like you, I work in the housing market as well, so I see it on the ground. You know, I work with buyers and
Right.
sellers all the time. I can see what's happening in front of me, so it's easy to forecast over here. And what is so exciting about talking to you is that you kind of come across, or you're coming to the same conclusions, but based on the fundamentals of what you're seeing. But I think the frightening thing about it is that the measure of the downturn, because as everybody else, you know, you're caught in the atmosphere of it's all okay now. You know, we got through 2008 was a long time ago. You know, the Big Short happened. There's been a lot of technological innovation since. It almost feels like it's old-fashioned now of what happened at that point in time. And then we had COVID, and well, COVID didn't crash the property markets. In fact, if anything, it produced that tremendous boom that as we talk about peaked around 2022. And here we are right now in 2025. You know, Donald Trump's in, the stock market's going okay. And okay, we've got this hope for peace for the world, that Trump's going to negotiate these peace deals, and everyone's kind of getting back into the groove of things, which is it's all okay. You know, nothing bad is going to happen. And unfortunately, people like you and me will be kind of labeled as, you know, here we are, the doomsdayers that are coming.
Doomers.
That's right, going out and saying, oh no, there's a big crash is coming. But my subscribers will be well aware of it, because they're subscribing to me for this timing. So they're used to commentary on this. But the thing is how bad is this going to be? Are we looking at something that is going to be worse than what happened in the global financial crisis, as we call it here? The Great Recession, I think, is what you labeled it there.
Yeah, and it is also, we call it global. Some of us call it global, some great, but yes, yeah, I think it's going to be worse. I think that we're going to see that fully play out. I think you might even see the government have to buy homes, like from these builders. I think that might be why Warren Buffett actually just bought into the builders like Lennar. He always sniffs out a good bailout. He did it with my former company as well. So I think it's going to be worse because of the demographics. You know, we are the boomers own the most homes. 15.6 million of them, unfortunately, will not be here in 2035. And so this is a massive headwind. And now with immigration, you know, being stopped, that was our only population growth. We're not having babies at replacement rate. And so I told someone today, it's like, you know, I stare at my ceiling every night wondering what could they possibly do, because they've done every other thing. I mean, many municipalities around here give away houses already, like in our states that used to have large manufacturing, but they don't anymore. And so that potentially could happen. I think you're going to see that. And I think you're going to see the government get into affordable housing, but it's not going to be enough to really arrest the decline, because we simply don't have enough people. And, you know, I make a joke, unless the robots need houses, you know, then there's just no way that home prices will continue to appreciate. And I honestly think they'll go back to looking like they did before the 70s. You know, it's just like this. And they tracked with median income, because it's going to become again about what people can actually afford. And, you know, the investment, you're going to get so many speculators that are going to get wiped out, that are getting wiped out right now. I think it's going to be very much like the Great Depression, where back then everybody was a landlord too, and they realized they didn't want to be a landlord anymore because it was so horrific, just in terms of all of the costs and things like that. And so I do think it's going to be worse. And I like to say that I think housing is going to become boring again, because It just a massive appreciation. And, I've heard the theories about those long cycles and I agree with them. I haven't done as much research as you have on that, but I'm definitely going to check out the second person you mentioned. I'd heard about the first. So yeah, I think this is going to be much worse. And people, I mean, a house is a depreciating asset. I mean, I don't understand why people don't understand this. The land is what's valuable, but again, why would land be valuable if there's no people? You know what I mean? And if there's no farm, I mean, there's a reason it has to be valuable, like it has to serve some function. And for so long here, property has just served the function of gambling. I saw a tweet by Anthony Poplia. I don't know how you say his last name, but he's like, oh, wouldn't it be great? It's talking about Open Door, which is a joke of a company. Wouldn't it be great if we could just bet on how much a house would sell for? I'm just like, okay, housing is a casino now. It is so clear. And, the casino the doors are getting closed.
It sounds like an Australian idea. That's the type of thing that we would hear over here. I'd be so excited for you to look into the cycle. So the second person I mentioned was a guy called Roy Wenslick. There's so
Yes.
little about him on the internet. He was a real estate valuer, and he did his around the same time as Homer Hoyt, because after in that 1920s period, there were so many studies that were done. And then when the 1930s happened, there was kind of like this flood of, why has this happened? And
Mm-hmm.
people like you and me sort of said, oh, let's have a look at the housing market. And
Right.
collecting data at that time was much harder than it is now. I mean, now we have so
Yes.
many tools. It shouldn't. The problem now is what you mentioned earlier on, which is how expensive is it to get this
Mm.
data? It's so hard. When
Yes.
you're like you and me, and you want to do a academic analysis on the market, and you
Right.
can't actually buy. They want thousands and thousands of dollars for the data. But
Yes.
at the time, he worked in his father's real estate company, and he gathered all this data from different real estate companies, and he looked at the number of transactions. And after the 1930s, in 1936, he wrote his best-selling book called The Coming Boom in Real Estate and What to Do About It. Well, actually, it was more of a pamphlet than a book, but it still made the New York sellers uh, bestseller
Wow.
list, sort of bestseller list. And it was forecasting this boom. And but it was very fundamental as to why he forecast it would happen. And he did it based on this idea that he had uncovered, like Homer Hoyt, that there was an on average 18-year cycle in the US. And that cycle has been very consistent since. It's only really been
Right.
interrupted by periods of war. And it's what has enabled, a few other names, Fred Harrison, Fred Foldbury, who's now passed away, but to accurately forecast, when the recessions are going to come decades in advance. You can sort of forecast these things, and that's one of the sides of what I talk about. But of course, underneath the forecast, there has to be a reason why it happens, which is
Right.
the economics of it. You
Right.
can wipe away a cycle. You can stop housing markets by booming, by fixing the way that we lend credit on them, fixing the way that we tax
Right.
out, with all these
Right.
different mechanisms that we have. But it just so happens that the economies have chosen that, the banks predominantly lend against housing, and so housing has now
Right.
become, you said, financialized, like a speculative asset, more so than it's ever been before. Which is,
Yes.
so you and me, we talk about the same things. But what's exciting about what you talk about, because I so rarely meet people that are able to explain it to audiences like you are, and is the population growth factor. And that is that
Mm-hmm.
housing markets aren't difficult to analyze. As you say, it's the land that appreciates. But all of these researchers, now, you read an academic article and it sounds incredibly intelligent, and the language is intelligent, but at the core of it is, we need population growth into areas that are limited in supply, into areas where
Mm-hmm.
everybody wants to live. That's why they're limited in supply, in order for markets to actually have the demand for the prices
Right.
to go up in the first place. And what
Right.
Canada, has recently done, they did their immigration stop, and then their vacancy rates started to explode,
Yes.
and their property prices stagnated.
Yes.
We had the same thing in New Zealand. Now our government are also talking about it. Well, we'll stand back on immigration because it's very unpopular. Nobody wants immigration. At
Right.
this point in
Right.
history, wherever they've lived, they don't want people coming
Right.
in. now that it's, we have Trump in that is anti-immigration, it has to cause an end to the party.
Yes.
So the
Yes.
timing is kind of there. So I guess the question, and again, I'm just so happy to have had you for an interview. But the question is have we reached the peak in the US yet, or is there like a little bit more to go, do you think, from the incentives that are being pumped in?
I think we are there. However, entities like the National Association of Realtors are refusing to acknowledge it. And so I think it could take a little longer for awareness, but the fundamentals are there. And one of the reasons we're not seeing more price declines is because the market is frozen. I mean, we had the worst existing home sales last year since 1995, and we've increased population by 20%. I mean, that has to tell you there's something really, really wrong. And the lowest first time home buyers on record last year since they started tracking in the 80s. So I think we're there. You can look across these markets, you can see prices getting slashed on the listings. But we've got kind of a cartel in the United States that controls that data. And they are doing everything they possibly can for it not to look or not to actually reflect reality. So I think, though, by Q2 of 2026, they're just there will not be questions anymore because of the delinquency, which I don't even, I honestly didn't think that would be a big part of the story early on, because I believed all the credit quality gospel singing. And then I started seeing in servicing, I actually saw what was actually done versus what everybody was saying. But yeah, I think that people need to see that delinquency go even higher. And the problem as well there is that we don't have good measures for delinquency because Fed tracks commercial banks. Well, they don't do the majority of lending in the United States anymore. It's the non-banks. And so you have a private entity who's has vested interest tracking that and reporting to the media. However, they don't have the largest, what we call specialty servicers, and that's people who handle delinquent loans. And so we have a lot of delinquency right now. We just are unaware of it to some extent. But I think I think as that increases as well, awareness is coming. But I think the fundamentals are there. I mean, I think it's already started to happen in so many cities across, and California seeing price declines is, to me, is a huge sign of the weakness, because people have been so delusional about California for so long. But yeah, I think we're there. I think though true awareness may take some time, unless we get some sort of credit event, which I feel like is happening and brewing in the United States right now with this auto subprime issues that you're seeing with all these banks that were lending out to Tricolor, this big auto lender who was lending to the immigrants without credit scores and things like that. And so you're starting to see contagion to Jeffries, West Alliance Bank, Fifth Third. And so I think we might actually get a credit event, very similar to how subprime mortgage debt started that credit event last time. It could be an auto this time. And then I think you could see an acceleration of awareness, because, you're going to, at those, where these places that had losses, you're going to have job loss. But yeah, I think this fall is going to be very tumultuous, and we could see a real acceleration of awareness.
Yeah, absolutely fascinating. So I guess your advice to and your timing, by the way, it's spot on for that 18-year cycle. It couldn't be more accurate. So you've come across all of this, which is sort of congratulations, because I think your research is going to prove to be very accurate. But I guess your advice really right now then to first-time buyers in the US, which is hold off. Would you advise them to buy into this market, or would you be saying, no, please don't do it?
please don't do it. Not right now. I mean, everybody's situation is different. And if you don't have to take out leverage, that's a whole different thing, right? But taking out leverage when home prices are this high and with all of these headwinds that housing is facing and all of that inventory, I mean, somewhere like Dallas, just it really makes me sick to my stomach when you see that many homes, empty homes. And so right now, be prudent, save your money. I do believe there are going to be buying opportunities, in the next 18 months, but this is not the time. It is so overvalued right now and inflated. People will overextend themselves, and then one person will lose a job, and then the next thing you know, you're fighting about money. You lose your home. You get divorced. I mean, this is when I managed default, I cannot tell you how many times I heard those stories. And in fact, that's what happened to me when I was young. My parents lost our home when I was 9 during the last big inflation cycle. They bought thinking they could afford it, but they couldn't as rates rose. And so, what is the number one thing couples argue about? It's money. And these are huge. These economic cycles can have huge impacts on you personally. And I don't think that people understand that because financial education is so abysmal in my country. They just don't even understand that a lot of their problems are driven by these economic policies and the cycle.
Yeah, you really touch my core when you talk about that, because that's really been the motivation for me doing this over the years. And, the work that I do at Prosper, which is, a lot of work to sort of stop the cycle. Let's stop the boom
Right.
and the bust, because,
Right.
as exciting as it is to analyze all of this and to pick when the peaks are going to happen, and to, sort of teach people, the people that sort of catch on to this, they learn how to advantage from it, is a very real human story at the bottom of this.
Yes.
We're not really supposed to be spending our lives trying to speculate on financial markets and work out the timing and, gain wealth in that way. That's not really what makes life valuable. And when you get these
Right.
downturns, the suicide rate and as you
Yes.
said, the divorce rate and the fallout on the other side is just, well, that's life changing and destroying, really. So, I'm really grateful that you sort of kind of ended on that point, because I think that's what motivates you in this as well.
Yes.
Yeah.
Absolutely.
Yeah. So thank you so much. I'm so grateful that you spent the time with me, and I know it's evening there, so double thanks for that. Can you please let people know where they can find you and find more research that you're doing? And just before you say that, I will remind my subscribers that as much as I talk about a cycle in an Australian context, it's to the US, still the biggest financial economy in the globe, that is the leader of this cycle, and it's where we need to look for all the leading indicators of when the financial economy is going to go, and you couldn't be a better person for us to sort of subscribe to and have a look for that. So where can people find out more information?
Sure. And first, let me just say that it was my sincere pleasure, and I've really enjoyed this conversation. And thank you so much for the invite. I've loved it. So they can find me. You can find me on X, Twitter, M3_Melody. But I do my writing at M3 Melody Substack, and I also infrequently post on my YouTube channel, M3 Melody YouTube. And so that's where you guys can find me. But this has been fantastic. And I do agree. I mean, we are a globally synchronized economy, and the US is going to lead. And Canada is really having its fun as well right now. I mean, I think in many ways they're a little bit ahead of where the US is, but we're going there.
Yeah. I wrote about Canada a week or so ago, and I was saying the same. Like, is this what it's going to look like on the other side? Because New Zealand is going that way as well. New Zealand's market's kind of really gone. So, yeah, it's very interesting. Well, I won't keep you any longer. Thank you so much. And yeah, hopefully we can do this again at some point in the future.
Absolutely. Absolutely.